This is a nasty pile of legal articles explaining mergers and acquisitions, and this is the easiest way to explain mergers and acquisitions through 3 easy steps. There are 3 possible outcomes for your equity. They're continued, they're cashed out, or even worse, canceled. Because the stakes of a merger and acquisition include life-changing amounts of money, you can't afford to mess this up. So I'm going to show you what actually happens in mergers and acquisitions, how you can prepare for it, and how to optimize your equity. The best place to start is by pulling up your equity agreements. These are the documents that you were first given when you were first granted equity. There are 2 specific documents that you'll want to look for. The first one is going to be the plan, also known as the equity incentive plan, and the second document is going to be some form of grant agreement or grant option. Within those documents, you'll want to look for the section that is titled change in control or something of that nature. This will help you understand the few guarantees that you can hold on to, as your company cannot unilaterally void or cancel the contract. These 2 documents serve as the constraints within which the board of directors makes decisions about the actual deal. Outside of that, it is a free-for-all for the board and the purchasing company to figure out, as long as they stay within the financial, accounting, and tax laws. This is why mergers and acquisitions can be difficult to generalize, because a merger and acquisition is just a contract, and no one contract is the same. These kinds of transactions can vary wildly from deal to deal. When the board and the acquiring company are making decisions about what actually happens to your equity, there are a few factors that they take into consideration. Your current equity plan, the actual deal contract, tax consequences from a company and individual standpoint, the transaction's financial accounting, willingness of the buyer to preserve your equity, and the difference in the stock's value between the buyer and the seller. The trick here is to determine what is in your control and what's out of your control, so that you know what's in the realm of possibilities. The board of the company that's being purchased, also known as the target company, no, not that target company, and the purchasing company will get together and decide the terms of the deal. By definition, you probably didn't have any say in this event, and therefore you have no control. The truth is, even if you're a C-suite level executive, you may not have much say in this process. So it's important to focus on what you can control. Let's quickly address the types of mergers and acquisitions before we address the outcomes. First one is mergers. This is a form of acquisition where 2 companies merge and there's only one company entity that's left. This is most likely for larger or public companies and is oftentimes done for tax considerations. The next is acquisition. This is where a part or all of the company is being purchased, and they could be purchasing stock or assets. The next one is divestiture. This is a transaction only affecting a portion of the company, and there are several different types of divestments: spin-off, split-off, and carve-out. So that's what's going on from a high level, but what are the actual outcomes that could affect you? There are really only 3 possible outcomes for your shares or your options during a merger or acquisition. I like to call these the 3 C's. Your equity is either cashed out, continued, or canceled, or some combination of those. When shares are continued, they're either being assumed, converted, rolled over, substituted, or swapped. When the canceling of options happen, it's usually reserved just for unvested shares. In the case of equity being cashed out, the acquiring company may pay out the whole stock option pool, both vested and unvested, in cash. The company may even give you a choice or require you to do some combination. Put differently, you're either walking away with buyer's stock or option, cash, some sort of combination, or nothing. Let's go ahead and walk through each one. If the purchasing company exchanges the options, then oftentimes vesting will continue without modifications, unless there's an accelerated vesting schedule. If the purchaser doesn't exchange or accelerate the shares, then they can be lost. The good news is that if you're still employed by the new employer, then oftentimes you'll receive a completely new grant with no relation to your previous equity in size or investing. These new grants would reflect the acquirer's option strategy. It would be as if you were a new hire with a completely new vesting schedule. When it comes to conversions, it's pretty straightforward. Vesting options get exchanged for vested options in the new company, and unvested options get exchanged for unvested options at the new company. These options are converted according to a negotiated value of the share price. If the stock price is underwater, then they'll most likely be canceled, and you'll be issued new shares with a lower strike strike price as a way to incentivize you, the employee, or the executive to stay. What about the taxation here? Well, when it comes to swapping shares or options, these are often considered a tax-free exchange, just like you would see in a 1031 exchange for rental properties, for example. But the IRS is weary of you getting more value in the exchange without it being taxed. So if there is a possibility of getting better terms or switching the type of options, for example, from ISO to NSO or vice versa, it'll likely trigger taxes or you'll lose the qualifying benefit of the incentive stock options. There may need to be an adjustment of the strike price here to prove to the IRS that you're not getting a larger spread on the exchange. Outside of these nuances, when rolling over shares or options, for the most part, the taxation of stock options doesn't change. There's still ordinary income, capital gains, and AMT, depending on the type of equity, whether it's incentive stock, non-qualified stock, ESPP, or restricted stock. This is why you should consult with a professional. Being cashed out can be an exciting proposition, but it can also bring its own challenges. If it's a private company, then valuing the shares can be difficult in comparison to a public company where the shares value is really easy to determine. The value is more subjective and is open to interpretation from bankers and other valuation experts. A common model for valuing stock options is called the Black-Scholes, which takes into account multiple factors such as the strike price, valuations, and how much time a stock option has until its expiration. If you think about it, the actual value of an option isn't as simple as the fair market value price. For example, which option would you rather have? A stock option with 10 days before expiration or a stock option with 10 years until expiration? You'd probably pick the one that has 10 years until expiration. When a company is public, the acquisition is pretty straightforward because they're mostly structured as a stock purchase and not an asset purchase. What this means is that the purchase price is the share price on the day the actual deal closes. Depending on recent performance, the sale could even be at a premium to that price. But because the stock market is so volatile, the two parties may create an acceptable price range for the stock with a ceiling and a floor. And if the shares are trading outside of that range upon the date the deal closes, then the deal may need to be renegotiated, restructured, or completely canceled. Although this isn't likely, your unvested shares could also be cashed out. This was the case when Twitter was purchased back in 2022. Both the unvested options and RSUs were cashed out. That's a pretty sweet deal, but do you have to exercise if it's being cashed out? In an all-cash deal, you'll likely have to exercise before the sale happens if you want to keep the stock. These shares will then be sold to the buyer as part of the acquisition. Depending on the structure of the acquisition, you may have to exercise your options before the deal closes. If you were to exercise in this case, you'd be given whatever the shareholder gets: cash, swap shares, or some sort of combination. If the exercising isn't mandatory, should you exercise? It's important for employees to realize the risk in a merger and acquisition. You can be sure the purchasing firm or company will be negotiating the lowest price possible, adversely affecting your stock. So the prudent and conservative thing would be to wait it out. Why? Because typically repurchase agreements only buy the stock back at the lower of two prices: the price that you paid for it or the fair market value. But you may be thinking to yourself that companies are purchased because the buyer thinks that they can flip them in a few years for a healthy profit. You may be thinking to yourself that these investors know things that you don't, which may be true, and therefore it makes sense to continue to hold on to your shares. But you have to remember that your individual risk capacity varies greatly from a company that is taking on different risks. There's one weird tax quirk about incentive stock options being cashed out. If you're not required to exercise and you're just being paid cash for shares, then you'll owe ordinary income on the gain, which makes sense, but here's where it gets weird. Typically with incentive stock options, you avoid FICA tax or Social Security and Medicare tax on the bargain element, whether it's qualifying disposition or disqualifying disposition. But when you're paid cash for your incentive stock options, you'll have to pay FICA tax. Things can get even messier from a tax perspective if the company is buying your options with stock and cash. If your shares are cashed out, then let us help you diversify out of your equity. This comes down to the two documents that I mentioned at the start: the plan document and the grant agreement. If your options are vested, companies cannot cancel them unless the plan allows for it. In this situation, your company may end up repurchasing some of the shares. Note that repurchase agreements will usually buy back the stock at the lower of two prices: fair market value or the exercise price. So it could very well be repurchased at a loss, or at best, your exercise price. There are three possible outcomes, but technically your company could give you a choice between continuing some and cashing out others. Let's quickly address the types of equity you may have. You probably own between maybe stocks, some vested options, and some unvested options. When it comes to stock, these are typically treated the same as option holders. For example, if option holders were cashed out, then so would actual stockholders. When looking at your vested options, most of the time they are secured, but you'll want to double check your equity agreements. Sometimes with asset acquisitions, the buyer is buying the asset, not the stock, meaning your rights as an option holder will not transfer. This is most common for pre-IPO and smaller companies. As for unvested shares, it's common for the equity plan to allow the board of directors or other designated committee members to determine the outcome of these shares. Frequently, companies have an acceleration clause that accelerates all or a portion of your equity. A recent study done by an equity consulting firm found that 90% of surveyed companies fully accelerate all unvested time-based equity grants. And if your grant doesn't have an acceleration clause, then they may expire. While acceleration can be a pretty sweet deal, there are a few drawbacks to acceleration. If the change in control clause requires acceleration, then the purchasing company may view that with the potential that it'll lose key employees, prohibiting the deal from actually going through. In addition, the acceleration clause may be hard to actually trigger, as some of the companies may have multiple triggers. For example, the clause may consist of specific events such as greater than 50% of change in board seats or the purchase of at least 40% of the voting stock of a company. The National Association of Stock Plan Professionals found in a recent study that 66% of companies have a double trigger acceleration clause if there is a change in control. Here's some more of the downsides of acceleration. There's this one-off tax rule that could destroy your taxes if your shares are accelerated. What it says is that only $100,000 worth of incentive stock options can vest each year. Anything vesting above $100,000 will be treated as a non-qualified stock option. In the same vein, a graded vesting schedule unintentionally spreads out the tax across multiple years, while acceleration can concentrate it, pushing you into a higher tax bracket. For highly compensated executives, acceleration may also cause problems under the IRS's golden parachute rule.